All right, so let's take a deep dive into what happened in the stock market today. It's been a pretty wild week already, but stocks just took a major tumble, and I'm sure a lot of us are left wondering what in the world is going on.
Yeah, it wasn't a pretty day for sure. We saw some big drops across the board, really. The S&P 500, the Dow Jones, even the Nasdaq, which has been strong lately, all took a pretty big hit. We're not talking about, a small little dip here. This was actually the worst day that we've seen for the market in over a month, so it can feel a bit unnerving.
Exactly, and I think for a lot of us, especially those of us who maybe aren't, Wall Street experts or are just, kind of figuring out this whole investing thing, it can be really confusing to try to understand. So what exactly caused all of this to happen? Well, we've got some great analysis from Market Deep Dive to help us kind of break it all down.
Yeah, and the analysis seems to point to a few key things that are kind of happening all at once. First of all, we saw tech giants like Nvidia and Apple really leading the decline today. But this wasn't just like a random, tech slump or anything like that. What's really fascinating is that it kind of signals a risk-off trading environment.
Okay, so risk off. I've heard that term before, but what does that actually mean for someone like me, an average investor?
Sure. Yeah, think of it this way. When investors start to get nervous, what they tend to do is pull their money out of assets that they see as riskier, like those high growth tech stocks that we were talking about. And instead, they move their money into things that feel safer, like bonds. So it's kind of like a flight to safety.
Yeah, that makes sense. So tech stocks are often seen as more volatile. So when things start to get a little bit shaky, people want to maybe be a little bit more cautious.
Exactly. And speaking of things that can kind of spook investors, we also saw that Treasury yields were climbing today. And you might be thinking, well, no major economic news came out or anything. So why would yields be rising?
Yeah, usually it takes some sort of big announcement to cause that kind of movement, right?
Right, exactly. But what's really interesting here is that sometimes the market moves on sentiment and anticipation just as much as, hard data. So it seems like investors might be betting on, future economic strength and maybe even a little bit of inflation, which would push those yields higher.
Okay, so rising yields are making bonds more appealing, and that can pull money out of stocks. But there was also something happening with the U.S. dollar too, right?
Yep, that's right. The US dollar is surging right now. And that's kind of adding another layer of pressure to the market because a strong dollar can actually impact company earnings,
Yeah.
especially for companies that do a lot of business overseas.
Oh, I see. So if our dollar is strong, it means American products become more expensive for other countries, which could hurt our exports.
Precisely. And that potential hit to earnings can make investors a little bit hesitant. On top of all that, we had some major companies reporting their earnings today, and the results were a bit of a mixed bag.
Yeah, earnings season always seems to bring, another level of excitement, or maybe I should say drama, to the market. So who stood out today? What were we seeing?
Well, Coca-Cola, for example,
Hmm.
they saw their case volume drop. And that could be a sign that people are starting to cut back on spending a little bit, which is never really a great sign for the overall economy. Then there's McDonald's. They're dealing with that E. coli outbreak that's linked to their quarter pounders. And as you might imagine, their stock took a hit because of that. Food safety issues can really shake investor confidence.
Yeah, definitely. No one wants to see that. But there was one company that actually seemed to buck the trend today, right? Tesla.
Yeah, Tesla's a really fascinating case. They actually beat earnings expectations, but their revenue fell a little bit short. What's really interesting is that their stock actually surged after hours. It's almost like the market was saying, okay, well, maybe there's still some hope out there.
Yeah, Tesla's definitely one of those companies that everyone seems to watch really closely. So maybe that after-hours jump gave investors a little bit of optimism.
Possibly, yeah. Tesla is part of what some people call the Magnificent Seven, these incredibly influential companies that really carry a lot of weight in the market. So you know how Tesla performs can sometimes give us a clue about overall investor sentiment. But even with that little glimmer of hope, tomorrow could be another big day for the market
Okay.
because we've got some pretty crucial data coming out.
Oh, like what? What should we be keeping an eye on?
Well, we're going to get the preliminary purchasing managers index readings, or PMI for short, and that's going to give us a sneak peek into the health of both the manufacturing and services sectors. And then we'll also get new home sales data for September, which will be interesting because the existing home sales market has been struggling lately.
Okay, so PMI and new home sales, but what do those numbers actually tell us? I know you're going to break it down for us, but just to set the stage, why are these numbers so important for investors?
Well, the PMI is really important because it essentially tells us whether businesses are growing or shrinking. And that can have a big impact on future earnings growth, which of course affects stock prices.
Right, so a strong PMI usually means that companies are doing well, which is that for the market. And what about new home sales?
Well, the housing market is often seen as a leading indicator of overall economic health. When people feel confident about the future, they're more likely to make big purchases like homes. So if new home sales are strong, it can be a good sign that the economy is doing well.
So we've basically got these two reports, PMI and new home sales. That could give us some clues about where the market might be headed next. Sounds like we've got a lot to unpack and analyze.
You know what's really interesting is that while we're all kind of focused on the US market here, this whole situation really highlights how interconnected the global economy truly is.
Right, it's like this giant puzzle, and all the pieces fit together. And when one piece moves, it can shake things up everywhere.
Exactly. Take the Bank of Canada, for example. They just surprised everybody by slashing interest rates, becoming yet another central bank to try and ease borrowing costs. Now, this move is meant to help their own economy, but it can actually have ripple effects on the U.S. market as well.
How so? I mean, I get that we're all connected, but wouldn't lower rates in Canada just help Canada?
Well, think about it this way. Lower interest rates in other countries can actually make the U.S. dollar even stronger because investors are always looking for the best return on their money. And if rates are lower elsewhere, the U.S. might suddenly seem a lot more attractive. And remember how we were talking about that strong dollar and how it's not always a good thing for U.S. companies, especially those that rely heavily on international sales.
Ah, I see what you mean. So it's like a seesaw. When one side goes down, the other side goes up. And in this case, a weaker Canadian dollar could actually mean a stronger U.S. dollar.
Exactly. That's a great way to put it. And that's why it's so important to keep an eye on what's happening globally, not just in our own backyard. But let's get back to that crucial data that we're expecting tomorrow. We talked about the PMI and new home sales, but let's dig a little deeper into what those reports might reveal.
Okay, so PMI first. You mentioned it kind of gives us a glimpse into whether businesses are expanding or contracting. What are analysts expecting to see? And how could that affect the market?
Well, the predictions for the manufacturing PMI are actually a bit gloomy. Analysts are thinking it might come in below 50, which would suggest a contraction in the sector, and that could really dampen expectations for future corporate earnings.
And weaker earnings usually means lower stock prices, right? Because investors are less optimistic about a company's future profitability.
Exactly. It's all a chain reaction. But on the flip side, the services PMI is actually expected to stay above 50, which would indicate continued growth in that sector. So it's not all doom and gloom. We might see, some counterbalance to that potential manufacturing weakness.
So maybe some good news mixed in with the bad news. What about the housing market, though? We talked about existing home sales being kind of sluggish. So what are we hoping to see with new home sales?
Well, remember, the housing market is often seen as a leading indicator of economic health. So if people are out there buying homes, it usually means that they're feeling pretty confident about the future.
Right. It shows that they're willing to make big investments, which is a good sign.
Exactly. So we're going to be watching those new home sales figures really closely to see if that weakness in the existing home market is spilling over into new construction as well. And we'll also be looking at median home prices. If those prices keep going up even though sales are weak, it might mean there's still not enough inventory to meet demand, which could keep pushing those prices higher, at least in the short term.
Okay, so we've got PMI offering some insights into future earnings. And then new home sales, kind of giving us a peek into the housing market. What else should we be paying attention to in this? Uncertain market environment. What are the big things you're watching?
Well, the bond market is definitely worth keeping an eye on. We talked about how Treasury yields have been surging. And if they continue to climb, that could put even more pressure on the stock valuations. Because remember, as yields go up, bonds become more attractive to investors, which can pull money out of the stock market.
Yeah, it's all about that balance between risk and reward, isn't it? Investors are always trying to find the best place to put their money.
Precisely. And then, of course, there's the Federal Reserve. And the big question is, what are they going to do next? Right now, the market is predicting a rate cut at their November meeting. But if this economic data starts to look better than expected, the Fed might decide to hold off.
So the Fed's decision could really kind of throw a wrench into things either way. It's like waiting for the other shoe to drop.
Exactly. Any shift in their stance on rates could have a big impact on the market. But speaking of the Fed, we can't forget about inflation. It's been pretty tame lately, but it's definitely still on investors' minds. If inflation starts to heat up again, It could force the Fed to take even more aggressive action, maybe even raise rates, which could be bad news for both the stock and bond markets.
It's like there are all these different forces pulling the market in different directions. And it's hard to know which one is going to win out in the end.
It's true. We've got economic data, company earnings, central bank decisions, and even global events all playing a role. It's enough to make anyone's head spin.
Definitely. It's a lot to keep track of, even for someone who follows the market pretty closely. But I guess that's why these deep dives are so helpful. They help us break down the complexity and really understand what's going on.
Exactly. It's all about staying informed, understanding the forces at play, and really thinking critically about how they might impact our investment decisions.
Well, I think we've covered a lot of ground today, and I feel like I have a much better grasp on what's driving the market right now. But before we wrap things up, I'd love to hear your final thoughts on what all of this means for retail investors like me.
Yeah, it's definitely a lot to digest. But I think the key takeaway for retail investors is to not panic. Market swings are just a normal part of investing. And even, these sharp drops like we saw today, they're really not all that uncommon.
Yeah, that is reassuring to hear. Because I think it's easy to get caught up in the fear when you see your portfolio taking a hit like that.
Oh, absolutely. But remember, the stock market is always looking ahead. So today's sell-off, it might just be investors adjusting their expectations for the future.
So it's more about reacting to potential future events.
Yeah.
Rather than what's happening right now.
Exactly. And this is where staying informed becomes really crucial. Pay attention to that economic data, those earnings reports that we were talking about, any announcements from the Federal Reserve. These are the things that really drive market movements.
It makes sense. The more you understand about what's going on behind the scenes, the better equipped you are to make smart investment decisions.
Precisely. And this is where, resources like Market Deep Dive can be incredibly helpful. They provide that clear, concise analysis that helps you cut through all the noise and make sense of these complex market dynamics.
Yeah, it's like having a guide through the jungle of financial news. But for those of us who maybe aren't, seasoned investors, what are some key takeaways from today's market tumble? What should we be thinking about as we kind of navigate this volatile landscape?
Well, first and foremost, don't let emotions drive your decisions. It's really easy to get caught up in the fear when the market's down. But impulsive moves based on emotion can often hurt your portfolio in the long run. Just take a step back, breathe, and remember that investing is a long game.
Yeah, it's like that saying, time in the market is more important than timing the market.
Exactly. And second, remember that diversification is your friend. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, real estate. That can help to kind of cushion your portfolio against those market swings.
So don't panic. Stay informed. And diversify. Those are some solid words of advice for any investor, especially during times like these.
Absolutely.
As we wrap up this deep dive into the market meltdown, what's one final thought-provoking question that our listeners can ponder as they continue on their investment journey?
Well, given everything that we've talked about today, those rising yields, the strong dollar, the mixed earnings picture, and all of that upcoming economic data, what are the key indicators that you'll be watching most closely in the market over the next few days? What signals will you be looking for to help guide your own investment decisions? It's all about being an active, informed participant in your own financial future.
That's a great question to leave our listeners with, because ultimately it is about taking what we've learned, applying it to our own unique situations, and making choices that align with our financial goals. And remember, even in a market downturn, knowledge is power. So keep exploring, keep learning, and stay ahead of the curve. Thanks for joining us on this deep dive.
It's been a pleasure.